Today's conversation is The Future of Venture Capital. Our moderator is Olav Sorensen, Professor of Organizational Behavior at the Yale School of Management, who will introduce our panelists and kick off the discussion. We welcome your participation in today's discussion. You can submit questions and comments through the question box on your screen. Now I'll turn things over to Olav.
Thank you. Yeah, so I think we have an excellent panel here today. I'm happy to introduce them. The first member of the panel is Visby Dabber, who has worked in the software industry for several years, first for Network Associates and then as one of the founding team of MyCIO. Now he's a partner at Sierra Ventures. He's responsible both for investments across borders in India and for software investments in the United States. Welcome, Visby.
Thank you.
We also have with us Katie Ray, who is also an SOM alum, class of 1997. She's been involved with a sort of a who's who of tech companies, including Lycos, AltaVista, and Microsoft, and now is the managing director at Techstars in the Boston location. Welcome, Katie. We're also hoping, although he's not with us at the moment, that Max Ventilla, who is Yale SOM class of 2006 and a co-founder of Aardvark, which is a social search company that has since been acquired by Google, will be joining us, although he's not with us at the moment. I will try and bring him into the conversation as soon as he can. So to start things off, the title of the panel is The Future of Venture Capital, and I thought it would be useful to just say a little bit about where we are in this space at the moment. So in October, the National Venture Capital Association released their press release about Q3 fundraising. And Q3 fundraising for venture capital had actually fallen to the lowest levels that has ever been seen since 2003. Part of that is the quarter was poor, but also fundraising as a whole in 2011 has been slow. Overall, fundraising for 2011 will probably come in at around $15 billion, which is roughly half of the levels that we used to see in the pre-crisis years. So I think I'd like to start off with your thoughts about what might be driving some of the weak demand from investors for the asset class. And maybe I'll start this one off with Visby.
Sure. So a few things, and I'm glad you laid it out in quantified form. So 15 billion this year. 2006 was 30 billion, so half that. 2000 all-time high of 84 billion. So that's how far off we are. So what's happened is pretty straightforward. The investors in the class are limited partners, and they come from pension funds, university endowments, large treasuries, and they have multiple billions of dollars in cash that they're putting to work in different asset classes. The venture capital private equity asset class is highly illiquid for them. They put money in over a period of 3 to 5 years and see returns over a period of 5 to 9 years. And it was always a low single-digit % of their total allocation prior to the internet bubble of 99-2000. So largest pension funds, largest university endowments, just like Yale, had it at low single digits prior to that. What happened following the internet bubble was there were extraordinary returns from this category. So everyone jumped into the category. Existing LPs, existing pension funds, existing university endowments increased their allocation. New university endowments came in and said, we have to be in this category. New pension funds came in. New treasuries came in. International pension funds came in. And the end result of that was all of us on the venture side started raising more funds and bigger funds because there was more capital to raise. There were offshoots where people would split up and raise new funds. So that's what happened in the last 10 years. Now that 5 to 9 year period has come to a conclusion, and the results are in. And the results aren't compelling. They certainly don't rival what they were in the decade that ended with the internet bubble. So now all the LPs are sort of shying away and saying, no, we should get down to our allocation like we had it before. That's the main reason for that happening and why it's going to be just 15 billion this year. The positive note is, in the last 3 or 4 years, there have been several new multi-billion-dollar technology categories that have been created: social, open, mobile, and then broad internet adoption in the world, such that the returns from the last 3 or 4 years are very compelling. So the next 5-year returns or the next cycle returns are going to be as compelling as they were earlier and unfortunately LPs have to get used to that cycle of investing.
So let me follow up just on one question here. I think it's nice that you sort of bring this back to the internet bubble, which was really the height of the fundraising. And you mentioned that the returns from that were low. I guess I was wondering whether you think that was because there was really sort of too much money overall in venture capital, or whether some of these inexperienced investors that started rushing in essentially were investing in either poor firms or maybe the wrong parts of the space.
Yeah, good question. So if you look at, let's break up the last decade into 2000 and 2005 and break it up into how much capital there was and what the opportunities were. So the capital was at an all-time high. Everyone wanted to rush into the category. If you look at what opportunities there were, what technological innovation was occurring, it was fairly minimal compared to the last 5 years. Google was the biggest thing that happened, and algorithmic-based search, and everything was centered around that. Now if you look at the last 5 years, you've got, I think there's 17 venture-backed companies with over $1 billion in valuation. You've got 4 that are going to enter sort of Fortune 1000 fame, Facebook, Zynga, Twitter, and a few others. And you've got real innovation happening and real opportunities to invest in. So it's a combination of there was too much capital when there was not enough innovation and technology disruption. Now there's less capital, but a lot of innovation and technology disruption occurring. Now the good news is, and this is a separate question, is that because the lack of capital isn't hurting disruption today. And the reason for that is startup costs are lower. Today's entrepreneurs and today's ideas are not algorithmic-based heavy IP. They're simpler ideas based around social, mobile, and international expansion and growth. So entrepreneurship and innovation hasn't stopped even though there's less capital.
Yeah, so I think that's an interesting point, and I want to cycle back to that a little later in the conversation, but maybe we could turn over. So Katie, I was wondering, you're sort of sitting on the opposite coast. Do you share Vispi's perspective on what's been happening in terms of why we're seeing less venture capital money now?
I mean, in broad strokes, absolutely. I mean, I think the LPs are gun shy. They're also trying to figure out, where they actually have cash to invest. They have lots of illiquid assets, and, everybody has been shying away from venture. Now we're seeing new signs, I think, in a bunch of the lead LPs saying, all right, we've been bearish enough on VC. We want to put our toe back in the water, but I totally agree that their allocations have kind of gone back to what they used to be. I also think while the topic here is venture capital, we can't ignore what's happening in the angel space, because I think there's been an explosion of activity there and a professionalization in that space, which has filled some of the gaps where traditional LPs have left off. So you've seen this rise of what are called, micro VC angel funds out there, both on the West and the East Coast. And I know we'll get into accelerators later, but also the rise of that, which, again, act like venture capital funds. And, people can't forget that I think always, and please someone, I don't have the specific numbers here, but for a long, long time, half the money being invested into the early stage has been from angels. And traditionally individuals and then groups. And now we're seeing the next rise of micro VC or angel funds, which I think are going to play a very, very important role, especially in capital efficient startups. So just be my addition there.
Yeah, I think bringing in angels is actually a really interesting point. It's hard to sort of know exactly what the numbers are on angels, because oftentimes their investments, particularly some of the very early investments they make, aren't really registered anywhere, and so you don't know exactly what the total money is. But what I was curious of is, do you think maybe that some investors that had been going in as LPs before might now be deciding to try and invest, as part of an angel group on their own, and that could explain some of the decline in sort of traditional fundraising?
I think that's some of it. I mean, I think there are many more mechanisms by which people can invest and get into, you know, quote-unquote hot deal circles. So I think given how people are connected today in a way that they weren't before through social networks and other means, you know, lots of people are not necessarily joining groups, but joining syndicates of people where they respect them, they've worked with them, and they're each angels. So in Silicon Valley, this happens all the time. You might be in a group of 10 people, and somebody understands the gaming industry very well, and somebody understands, you know, e-commerce, and somebody understands social, you know, next generation social media, and they all rely on each other to make their angel investments. So I think, you know, that has certainly massively grown over the last 8 or 10 years because of how we're connected to each other and how information can flow pretty easily between people. And I think, therefore, when you have that amount of knowledge in a syndicate, people start to get comfortable with their decisions, and they can put a lot more of their own capital to work. I also think lots of people who used to be individual LPs in funds, well, I think they still are, they too haven't seen the returns. So they're wondering, why am I putting my individual money there? Why wouldn't I just go out on my own? So, you know, same phenomenon.
Right, right.
Yeah, Olav, I'll chime in. I'm not seeing that at all. The individual contribution towards a venture fund is so small that it doesn't affect us. Most of the money is coming from LPs. And LPs are so large. I mean, if you look at just our endowment at Yale, you look at any of the pension funds, it's too hard to manage if they're going to directly invest into companies and into incubators, et cetera. So it's not like they're bypassing the venture capital intermediary and going directly to portfolio companies. So, and then there's one more thing that's actually pretty important. It's more of an accounting phenomena, which is called the denominator effect. And what that is if you look at percentage of venture in an LP's portfolio, let's say it's at 5% and it's illiquid, so it's always lagging marking to market. And you look at the rest of the portfolio, which is liquid and is being marked to market on a minute-by-minute basis, because of the crash in the post 2008, the denominator effect has taken place, and we haven't marked our assets to market as quickly as the public markets would. So from an accounting standpoint, it looks even worse. It looks like an even higher allocation towards private equity and venture for an LP's portfolio.
Yeah, so that's, I mean, I think that's an interesting point, and especially to the extent that the institutional investor is trying to maintain some sort of asset allocation ratio, it means that they may feel like they need to, you know, sort of move money out of venture capital or, you know, sort of vice versa into other asset classes. So Max has actually joined us. I'd like to welcome him and maybe bring him into the conversation. So Max, I don't know if you have any potential thoughts about the question that we're talking about, is essentially why has venture capital fundraising been running lower recently than it was at pre-crisis levels?
Well, so I mean, I think that there are two reasons, and I'm speaking from a vantage in tech and probably consumer internet specifically, and venture is much bigger than just that. I mean, clean tech and biotech and lots of other sectors. But speaking about tech, you know, there are two things that go on. One is things that are internal to essentially VC fundraising and the VC environment, you know, ignoring the actual market in which they operate. And there, Visby, I think, went through the major factors that are causing, you know, more funds or less funds over, you know, different cycles to go into VC and bigger funds to form with more partners or kind of scaling back. But then the other piece of it is how the technology industry has changed in which VCs are investing. And there, I'd say there are three big changes that have happened. One is the cost of kind of getting to product market fit or proving out your concept has just plummeted in the last 10 years. So it is not hard for engineers to get the hardware they need, to tie into the cloud services they need, to get kind of minimal distribution, to essentially see whether they have an idea that really is able to scale into a larger opportunity or not. And before, it required much more money, and really it was only VCs, that were able to write, multi-million-dollar check sizes that could really explore out these ideas. The second thing that's changed is the supply of entrepreneurs has skyrocketed. So partially because it's a lot easier to try out ideas and get experience, there are way more compelling entrepreneurs today, in their kind of prime 20s years than there were 10 years ago, certainly pre-Bubble 1, which you're kind of comparing the current market to. And the third thing is the payout from venture for the actual startups has totally changed. It used to be much more kind of barbell shaped, where you'd have some kind of small bare minimum exit fire sale situations, and then you'd have some kind of large big exits. And now, because tech companies are increasingly trying to get in kind of qualified middle managers who they have a difficult time grooming and keeping internally, and because they have so much money on hand, they're much more willing to do these kind of semi, acqui-hire deals where they bring in 5, 10, 15, 30, 50-person companies for under $100 million. And so that, again, has totally changed, if you're investing in one of these companies, what you can expect the payouts to be and how you can influence those payouts as venture. And I think it's probably left a smaller opportunity where VCs can operate in the way they did before, which is essentially put large amounts of money into deals and try and push for, the very big exits, and really put more and more fuel on the fire as things look promising.
Okay, thank you. So sort of some demand-side ideas that I think we're going to come back to again in a little bit. So even though, sort of on the whole, venture capital fundraising is down, I mean, there is at least one area where, it seems to be a very sort of hot sector, and that's in the space of accelerators. It seems like almost every week the press is reporting another accelerator that's been started in some city or another. And some of them have even begun to offer their own funding for the ventures that they're housing. So I wonder, what you think has been fueling the interest in these kind of organizations, and whether or not this is sort of an evolution in what we're going to see as the venture capital model, or if this is a bit of a fad. And for this one, I want to start off with Katie, because Techstars is really one of the leaders in the space. So I'd be curious about your perspective.
Yeah, I think two things are happening here. One, there have been at least the early to market accelerators, and Techstars is of course one of those, have seen very broad success out of the graduates. And some of those successes have become big companies, and some, as Max just described, have been sold to large companies fairly early in their cycle. And so I think the investor community out there has started to kind of take it seriously. And again, this is bred by the same phenomenon that it's much cheaper to start something, especially internet-related companies, and kind of prove out the concept, validate that you should add more capital to the team. And accelerators are kind of a perfect environment for that. And then the second phenomenon that's happening, that's feeding the growth very recently of accelerators, is that governments and cities are grappling with, hey, how do we stimulate growth here? And so when you put those two things together, you have many more types of accelerators getting started. So some are government funded, some are like Techstars, where we are funded by our limited partners, which tend to be venture capitalists and angel investors. And some are, funded by universities, etc. So that's the explosion are not just pure accelerators like Techstars, but many other types of accelerators. And, I think it is parts of this are a fad. I think the ones that have a stable economic base where you have limited partners and you have good returns to your limiteds will survive for a long time, and I would certainly put Techstars in that category. I think some of the others, they have to kind of get on stable economic footing. So if they are government funded, to get to success, you have to put a lot of energy and effort and human capital behind them. So I wonder if you don't have limited partners and true economic interest in them, if they'll survive. That being said, I still think they will continue to make a big impact on their communities and will be around for a long time. Maybe they may morph if they aren't set up like a fund, but I think they will continue to have a big impact. And we at Techstars, we have a network of accelerators around the world. The enthusiasm for them is tremendous, and I think the spirit behind supporting entrepreneurs is such a powerful thing that I don't think that's going to die anytime soon. And unless there's another major structural change to how internet startups become founded, you can, in a local community, support 10, 20, 50 entrepreneurs working on things, at the very early stage, which is exactly what accelerators do. So I don't see it dying soon. I think some of them that don't have stable economic footing will die if we go into a boom period, but I think the rest will continue on, both for economic and kind of spirit reasons.
So, Bitsby, I'd be curious, Sierra Ventures is, of course, much more of a traditional VC model. How would you view accelerators? Do you see them as a threat? Do you see them as potential partners? Do they offer something that Sierra, as a sort of more traditional VC, can't?
Yeah. So it's not a fad. It's one of the most important new introductions to the venture capital ecosystem over the last 3 or 4 years, and it's completely complementary to larger venture capital firms. So just to explain how it worked is prior to the incubators and accelerators coming up, entrepreneurs had very few places to go to raise less than $1 million. They would go to friends and family. They would try and find ex-employees of companies like Google who had extra cash, etc. There was no formal way to raise capital, and there was no formal way to get trained towards being an entrepreneur, being a startup. And then the incubators came in. They would put in as little as no money, as much as 50 or 100K, get a company off the ground and immerse a 3 to 4 month immersion process, like a little mini MBA program for entrepreneurs, wherein they bring in speakers, etc. And it culminates with or terminates rather with a demo day that has a bunch of investors, and you look at future funding. So they didn't exist before. So everything that we looked at as Series A investors, where we put more money into a company, $2 million and upward, all had gone through this friends and family bootstrapped initiative, and it had been 1 or 2 years, and they had got to a certain stage. Today, almost everything we look at has gone through 6 months of an incubator process and has raised 300, 400, 500K through that process, and has got as far as its predecessors would have got in 3 years. So it's a positive outcome. Of course, you'd pay up a little bit more for that, but you take that for speed to market any day. So it's a very positive outcome. If you look at the success now, so where are we, and why is it not a fad? So it's not a fad for a few reasons. One is, earlier, all of us have mentioned this, but you can get started with nothing, and you couldn't do that earlier. With cloud and a few other things, you can do that. So, and then the second thing is, there's a lot of entrepreneurs who are ready to sort of, in their 20s, who are ready to give up the sort of life cycle benefits of a steady job and go and do this. And then the other sort of big reason is the opportunities are there. Again, if incubators were started in the 2000 to 2003 period, wouldn't be as successful. There just weren't opportunities. Social, mobile, international internet growth and expansion. So now let's look at the results. It's been 3 or 4 years of incubators that have come in, and I'll point out a few right at the top, and perhaps Max can point out a few others as well. 2 companies that are already valued at over $1 billion and big successes, Airbnb and Dropbox. Airbnb is probably an 18 or 24-month-old company. That's it. And Dropbox is similarly about a 3-year-old company. So these were initially in incubators, Y Combinator to be specific, and they've now grown out to be these big companies. So it's working. A few other things. Why it's not a fad and why there's future growth possible, it's a geographic play. There's enough in the Valley. Any new incubator in the Valley is just not going to have the quality of companies that the other incubators like Y Combinator and the rest have. So new geographies is where it's going to come up. There aren't any in India. There aren't any in China. I'd say the U.S. has pockets of them all over. But there's a huge opportunity there as well. And then the last thing I'll mention is there's a coexistence relationships is these accelerators and incubators have very small amounts of capital that are too small for the LPs we defined earlier, pension funds, university endowments, to invest in. So it's actually the venture community that invests in them. So almost all of us on the venture capital side have developed a formalized partnership with one of these accelerators wherein we put capital as an LP so that we can have early access to the portfolio.
Thank you. So I want to sort of shift over to Max now. So both Katie and Visby have, I think, outlined quite well, how sort of the accelerators are very attractive potentially to investors. If you put your entrepreneur cap on, I was wondering, how would you think about the trade-off between an accelerator and, say, probably not a VC given the size of investment involved, but maybe between, sort of working with an accelerator and having an angel investor?
So first off, they're certainly not mutually exclusive, and in fact, in almost all instances, if you're working with an accelerator, you would also work with good angels and have more likelihood to get at them. I'd kind of differentiate, though, looking at the kind of funding situation and especially, whether to go with an accelerator. If you're talking about a first-time entrepreneur, which makes up the vast, vast majority of entrepreneurs out there and, founders of startups out there, or if you're talking about someone who's had some success already and maybe gotten venture funding and possibly had an exit, the picture looks completely different to those two categories of entrepreneurs. For people in the first category, I'll say that something that was kind of unspoken in both Katie and Visby's description of accelerators, but I think is worth mentioning, is that they really provide a huge benefit, which is they accelerate you. There is a huge amount of kind of first-time learning that an entrepreneur goes through that is not that valuable, in that it's how to set up a company, it's how to kind of make sure you have the right shareholding structure, it's kind of how to make sure that you're bringing people in early in a comp structure that makes sense and isn't going to cause problems, that you're building culture in the right way, that you're thinking about patents and competition in the right way, stuff that's kind of obvious once you've gone through it, but man, can it cause some serious pain if you misstep. And accelerators, because they have plenty of people working for them who've successfully gone through and learned these lessons from their own startups, are able to just impart the learning. And then the second thing that they can do is they can centralize some things around recruiting or PR or investor relations in terms of sourcing new funders that makes sense to do centrally, that isn't really efficient for individual startups to be doing completely on their own. So I think that accelerators can serve a big benefit. Oddly, I think one of the big problems of accelerators is that they keep companies around that shouldn't be. And I think that one of the things that accelerators need to get better at is killing off the kind of, bottom half, bottom two-thirds of each class, and finding a good way to either, take the people that were working on those initial ideas that didn't get borne out and bring them into the others. So there's a model where, for example, the accelerator could keep a larger pool of equity in each of the startups that it invests in, and then it could use that not for itself, but to essentially give that equity to, founders of other startups in the class that didn't go on. And that's just one of many models where they could not only offset one of the negative things that I see them do with startups, which is essentially just keep startups around that really should end. But even turn it into a positive that there's this dynamic where a certain fraction of the class is just, in some senses, going to be DOA. When they come out and they try and get funding, they're not going to be appealing relative to their peers. And you see the same kind of phenomenon that you see if you go to a great high school. You know, one of the problems with getting into a great college is that they have really easy peers to compare you to. Compare that to someone who went to a high school where very few people go to, you know, top-tier schools. The negative is that you may not get noticed at all. But the positive is that if you do get noticed, you're not going to be brought down by the direct comparison to your peers. And you kind of see the same thing going on in startups. And that's one thing that I caution entrepreneurs about when they think about whether to go the accelerator route, is to say, look, it's a very different competitive dynamic, and it may end up suiting you, but in some ways you're actually increasing your risk by being part of one of these classes.
And that would be especially true if they were going to pull the plug on the bottom half of the class no matter what.
Well, can I just say something? I think that's true of some accelerators, but I will specifically tell you in the one that I run, we have, you know, well north of 85%, you know, funding rate in seed, with a seed round. And so I think depending on that's why you have to look carefully at where you're headed as an entrepreneur. So sorry, just throw that in there.
No, that's great. Actually, I was curious as to your response. And Katie, I wonder if maybe what's happening is one of the things that you brought up is the fact that there are these different types of accelerators. And I wonder if maybe a lot of the problems with not pulling the plug is at the accelerators that are not getting their money from LPs and maybe don't have quite as strong incentives to, in some sense, spend their money efficiently.
Yeah, I mean, I think that's one piece. I think some accelerators try to narrow the field incredibly early. We're one of those, so we only take between 10 and 12 companies per session. And so we are expecting that most of our companies, the vast majority, will be funded because we've kind of done the hard work at the beginning. And, you know, we can still get it wrong, but, you know, when you narrow down to well south of 1%, you know, you tend to have a pretty good crop of people. And then the second problem is the one that you stated, which is like you don't truly have an economic interest. You might, maybe it's a city where you're trying to say, hey, we support all engineers, all entrepreneurs, and we just want our numbers to be large. And so in that case, I totally agree with Max that you might be better off weeding some of those out really, really early because they're needed on the other teams so that they can go faster. You know, those actual individuals are needed.
Yeah. So, Katie, I'm curious. Does Techstars operate with some sort of you could think of like almost like a commitment mechanism where if a company that you're incubating or is part of the accelerator has been going for a certain period of time and still has not managed to get any outside money, that you basically have a point at which you just say, well, that's the end.
Well, I mean, remember you have to bring in the human side of this, and part of what we choose for are incredibly tenacious yet flexible people. And so, you know, we tend to work with the entrepreneur to make them face reality in terms of, do they need to change their business model? Do they need to change their team? What do they need to do to make this a highly scalable and viable business is where we help them. And once in a while it is to face that, you know, there isn't, that this thing isn't going to work out. And those are very hard situations, but very real. And so it's not that we don't do that, but entrepreneurs resist that for lots of good reasons. I mean, that's the gene we're selecting for, are those persistent people. So it becomes a tricky human problem.
But
so
if I could chime in, I mean, I think that there's a fruitful middle ground between ending companies and letting them kind of go on with something that doesn't seem compelling, which is kind of forcing major pivots early on. and even changing the model a little bit where, right now, startups pivot kind of because they hit a brick wall, but there's potentially a lot of benefit in almost building pivots in as a requirement. I mean, imagine if when you took, business school classes, you just stayed in a class indefinitely. And the only the reason why people would generally stop taking one class and start taking another class would be because they hit a brick wall in that class. You'd get a much worse education and much worse outcomes than if you build into the system the notion that, every term or every semester there's going to be new classes that you take. And sure, you can gravitate back to areas that seem the most compelling, but you still kind of have to try it in a different form factor. And so that's another avenue where you can kind of push for more exploration early on and kind of look at a startup as a 7, 8-year, 10-year, 15-year thing where it probably makes sense to spend the first 18 months much more flexibly exploring possible form factors in the space than is the norm in normal, startup formation in consumer internet today, or mobile or related space.
I think that's very true. I also think we're in the process of really educating LPs and investors that should be the norm, and so I think we are evolving toward that. But I think venture capitalists, large venture capitalists, have this problem with their LPs around, wait, why are some of your more of your companies, blowing up? And because LPs get very uncomfortable with that and think, oh, those were bad bets. And it's like, no, a percentage of our bets should blow up because then we also get some really, really big winners out of, that system. But that's an education process.
Thank you. Yeah, so I want to turn to one other thing that's actually been a little bit of a consistent theme across a number of different responses, and that's that there's been a real sort of change in the really how difficult or how much money it takes to start a company. A couple of you mentioned that when we were talking about the effects of kind of the declining supply. Actually, one of the audience members wrote in asking whether or not, in fact, this the fact that it takes less money to start sort of cloud-based services versus something like, say, an internet backbone could be another reason why we're seeing a drop in overall fundraising. And you could even think of that as being related to sort of the rise of accelerators in that, you have many more companies now starting and, getting started with sort of small amounts of money. I wonder how you sort of see, that the internet in particular maybe has changed the nature of entrepreneurial finance and, entrepreneurship, or is this really something that's, is it going to be kind of a secular trend that we see going forward, or is this something, that's specific to things like Web 2.0 and a sort of a small class of investments where you can do, capital efficient entrepreneurship? So maybe I'll start here with Max, actually.
So, when I think of a startup, I kind of think of three, in some ways, disjoint phases. There's a get to product market fit phase, and kind of implicit in that is setting up a company that can get to product market fit. Then there's a second phase, which is a growth phase, where potentially you could start making money, but really it makes sense to operate at a loss and essentially carry out a land grab. And then there's a third phase where you, as a company, and a company that has been successful in a space and captured a meaningful share of a market, start to define yourself. And you especially start to define yourself as what you aren't, not just what you are. So, there's so many directions that a Zynga or a Twitter or a Yelp or a Facebook can go in, and it becomes increasingly important to say what you're not going to do and what's going to define your approach. And I think there's actually less change and less disruption that's gone on in the second two phases. It's really in this kind of early get to product market fit where the decreased costs have created a different dynamic. And so it's still in the context of venture, we're saying, like, this has not shaken up everything. The model still very much works, that you're putting huge amounts of money in at the growth phase at the kind of, you think about Facebook, Zynga, Twitter, Yelp. These guys raise hundreds of millions of dollars, which will get, good returns, anywhere from, 3, 4, 5x to, in the Facebook case, 25, 30, 50x on the large amounts of money that were raised, not just the early stage. And so I think that the most important is for startups or for entrepreneurs to kind of think differently about the get to product market fit phase in the context of how much easier it is to explore potential ideas, and that it's kind of like it's become easier to make progress in startups, and so startups need to raise the bar for what is considered sufficient progress for them to really kind of move on or double down. And mind you, it's worth noting that the bar has been raised by the market itself. I mean, it is very, very difficult to become a new destination site nowadays, or become a new kind of mainstream thing that people use and continue to use, and that isn't just a feature but is a product. I mean, even Twitter struggles with this. And they're huge and have been enormously successful and have changed the world. But I think it's a measure of actually how much higher the bar is now to maintain a defensible position and grow into kind of a big mainstay company in consumer internet. And so I think that's the major kind of ramifications for if you're starting a company now in the current environment of easier, less costly early stage development.
I'll just add here, I think those are totally right on, certainly with consumer web and internet, but I also see it changing some of the other sectors in interesting ways. I think the bar has also been risen if you're a robotics company or green tech or health IT or even kind of medical devices, is that the mentality is now to do much more customer development and validation earlier, and I think that's being driven by, the people with capital seeing that work in the internet space and then saying, hey, can we apply that to these other sectors? So I think that's very exciting and will change lots of ways that we look at new ventures in different sectors.
Do you think that it will work in other sectors?
I do. It will certainly, it has, listen, everything that is new is old, right? So, in any consumer device, people have been doing this for years, right? Taking, what already exists, slightly morphing it and testing it with consumers before they go and manufacture millions of them, right? But I think we're smarter about testing, smarter about being data-driven in our testing rather than just focus group-driven. And I'm seeing this, I live in Boston, and there's a bunch of activity at MIT around this, around medical device and how medicine is going to change. And I see them employing the same techniques, and I think it is working. I'm seeing it at the earliest stages, but I think it is working. I don't know about green tech and biology-driven startups. That's out of my zone of expertise, but I can't imagine that it couldn't have an effect there as well.
Mm-hmm. So Visby, do you want to chime in?
I will. I'll start with what Max said. So the first phase, very clear, there's lots of disruption there. And I don't know if you want it quantified, but if you break it up into what it takes to start a startup, there's infrastructure, servers, data centers, et cetera. That's all now commoditized and in the cloud, and through Amazon and a few other companies, you can slide your credit card and access that. That's a big deal. 10 years ago, a startup needed $2 or $3 million just to buy servers to set up their internet site. And then if you take the application layer, which is what they're building, and what consumers or users are going to access, that's been very easy to build as well, thanks to, specifically to start off with Apple and Android on the mobile, thanks to Facebook. It's pretty easy to develop an application that runs on social networks or runs on mobile. So those are the two reasons startup costs are very, very low. I'd argue that that second phase that Max describes also has some disruption occurring that's lower cost. So initially, in the growth phase, to acquire customers, whether it's B2B, B2C, consumers, or enterprises, it was just a very direct, unleveraged way of just adding more muscle. Either it was sales guys if you were selling to B2B, or it was SEM spend, search engine marketing spend, or online marketing spend on Google and the like. Today that's changed a little bit, and there was not much leverage. There was a pretty clear understanding. Today that's changed a little bit, thanks in large part to social. There's the ability to integrate into your product social features that encourage sharing that a consumer would do to get something in return. And the best example of that is a company called Dropbox here in the Valley, one of these incubated companies, around 3 years old, now justifiably valued at over $1 billion, that hadn't raised a lot. They'd raised less than $10 million to get to a decent revenue size. And what they do is online storage in the cloud, and they incentivize, instead of spending a lot on keywords and search engine marketing to acquire customers, they integrate it into the product, and they encourage us all to share it with our friends and to tell our friends to sign up, and we would get something in return. So there's some of that occurring, and I think we're scratching the surface on that as well. That was the one point I wanted to add.
Okay, thank you. So there's one last topic I'd like to make sure that we get to spend a couple of minutes on, and that's really in terms of thinking about sort of the geography of where venture capital is active. And if you look at kind of the last 20 years, I mean, certainly not only has the sort of the locus of the industry been really in Silicon Valley and Boston, but also that's where the vast majority of the investing, the funds being invested have also gone. I'm wondering if you think moving forward that these places, Boston, Silicon Valley, will continue to dominate the industry, or are we going to increasingly see investments shifting maybe to new parts of the world like China, India, Brazil, which are growing very rapidly. Maybe I'll start with Visby on this one, since I know that you're involved with some cross-border investments at Sierra.
Sure. So all important points around geography. We at Sierra invest in all over the U.S. and then China and India as well. And in China and India, it's a very different venture strategy for everyone. Whereas in the U.S., we're looking at disruption, new ways of doing things, new ways of accessing mobile or social, etc. In India and China, it's largely growth-oriented. It's consuming middle class coming into the category of consumption for the first time and looking towards spending. So they're buying financial services, education, healthcare, all for the first time. So it's not disruptive as much as it's growth. So what are VCs investing in there? There's some tech. Largely, in our part, it's mimicked what's happened here. Our most successful investment in India is a company called Make My Trip, which is like an Expedia of India. It has lots of local nuances particular to India, but it's online travel and middle class accessing that for the first time. But if you look at others who have funds there and are based out of there, it's everything growth-oriented, whether it's credit unions, banks, microfinance, schools, hospitals, etc. So that's the type of investing that's going on there, very different from here. The numbers indicate that certainly China has a potential to rival the U.S. in terms of venture capital allocations towards the country and towards industries in the country. India lags a little bit. Make My Trip's probably the only big success that's come out of India listed on the NASDAQ, and there's only a few others. So it's still early. If you just take online users, and again, consumer internet, there's only 100 million online users in India, all on pretty low bandwidth connections. But that switch is going to flip, and there will be 400 to 500 million on broadband. China already has that. So it's still lagging the U.S. Then I will shift to within the U.S., and there it's a little bit unfortunate because, in the last 10 years, thanks to the success in the Valley, lots of other regions sprouted up, Boston in particular, Mid-Atlantic, Pacific Northwest, Southern California, etc. And unfortunately, the shrinkage that we talked about right at the start of this call in capital has affected the outlier regions more than it has the two primary, which is Silicon Valley and Boston. So I think the promise prominence of both those regions has been exacerbated in the last couple of years.
But I also think there's, the rise of New York and a lot of capital heading there, which is, I think, an excellent thing to have happen. And, certainly from what I see with Techstars, there's interesting stuff happening in London and Europe that we hadn't been seeing in a while, which is excellent. And, there are also, to head back to accelerators, we have a whole bunch that are going to pop up in India, China, Africa, South America. So that tells me that certainly venture will follow that if it's not already there. We know there's a lot of angel activity there, but venture should follow that as well.
And I'll take a last word. We're getting close to the end. So Max, do you have any thoughts on the sort of geography of innovation?
Yeah, so I mean, one thing about VCs is they fill a dual role. They choose well, so they kind of pick winners, but then they also make winners. And I think the best VCs and kind of the most opportunity for VCs is in the making greatness phase versus choosing greatness role. And unfortunately, for kind of geographic dispersion of venture capital opportunity, that I think to really make companies more valuable as a VC, it requires a huge amount of existing relationships and track record and kind of opportunities to sell one company to another company or make a deal happen. And I think it takes a long time to position yourself to be capable there, and that kind of really makes me think that it's going to take a long time for VC firms as a category to become successful in new markets, and more importantly for specific VCs to be successful and not just lucky in new markets. Now obviously in the fact that these are still growth opportunities that are very different in places like China and Brazil and India than in the US, there probably is more of an opportunity to choose well than there is left in the American VC market. But I still think on balance it's going to take longer and be harder for pockets to form. I mean, I just see in Silicon Valley how many different pieces of the puzzle are right that have taken a long time to form and that are difficult to duplicate or nurture on their own in a new place.
Yeah, I think that, those are great points, and I think, they raise issues that would be interesting to talk about for yet another hour. Unfortunately, we don't have another hour, but, there may be ways in which, at least maybe VCs themselves, but possibly either through, sort of strategizing or maybe with some types of government support, may be able to get around those processes and speed up diffusion. One of the interesting cases there, I think, is Israel, where, essentially they brought in experienced VCs from U.S. firms that sort of brought the know-how about how to do the selection and maybe what some of the important issues are in advising, and paired them with local Israeli partners who then, had the local networks and also understood the local business environment and created their own, in a relatively short space of time, created a domestic VC industry in Israel that's actually quite strong now. But at this point, I'd like to thank our three panelists for joining us. Visby, Max, Katie, thank you. It's been great. And I will turn over to Ben for the final.
Thank you, Olav, and thank you to our panelists, and thank you all for joining us. Please send any additional comments or questions to Yale SOM at som.yale.edu. A recording of this discussion will be made available at the Yale SOM alumni portal, alumni.som.yale.edu, and on the QN Magazine website, qn.som.yale.edu.